of the Jacinta company now, and here it is. The second requirement. It was also worth, um, you know, around 10 marks, right? And it saying explain how the revenue from the internet services contract and sale of the equipment to share company should accounted for in accordance with IFRS 15 revenue from contract with customers. Okay, so yeah, let's move to the question now. We already done with the portfolio part, and now we will look at the revenue from revenue and inventories and revenue from share company part, right? So on 1st January, Jeseda company entered into a contract to provide share company with an internet service for 2 years. Okay, the contract price was agreed at 2 million, which was received in full on 1st January 2006. At the same date, Jacinta Company sold equipment to share company at its fair value of 500,000. At the end of the internet service contract on 31st December 2007, share company has a right to return the equipment to Jacinta Company and receive 20,000. Jacinta Company anticipates that the equipment fair value will be 75,000 in 2 years' time. The market for the second-hand equipment is very strong, and share company would be able to sell the equipment easily at the end of the 2 year agreement. The Jetseta company does not want to deal in second-hand equipment and therefore always prices equipment returns at an amount substantially below fair value. Share company has never returned equipment to Jetseta company in the past. Okay, so let's dive in with the solution now. Okay, and as I did before, here is our sheet in which we did the first part. Yeah, so moving ahead, we have now we'll start the second part. And what our requirement is requirement B, internet service contract. So, internet service contract in accordance with IFRS 15. Each performance obligation requires the determination of whether it is satisfied the transferring the control of goods or services over time or at a point in time. Okay. So according to IFRS 15, each performance obligation requires the determination of whether it is satisfied by transferring the control of goods or service or at a point in time. With regards to the internet service contract, to the internet service contract, the customer simultaneously receives and consumes the economic benefits of the provided services benefits of the provided service as Jacinta to perform it. Revenue is therefore recognized over time. Okay, we had a revenue of 1 million, okay, which will be recognized in each year of the contract. Oh, so revenue of $1 million will be recognized in each year of the contract at 31st December 2006. A contract liability of $1 million, sorry, $1 million will be presented as a current liability on the statement of financial position. Further, we will say that if IFRS 15 says that if the customer has a right to require the entity to purchase, to repurchase the asset at a price which is lower than the original selling price. Then the entity must assess whether the customer has a significant economic incentive, significant economic incentive to exercise the right. A key factor to consider is the relationship consider is the relationship between the repurchase price and the expected fair value of the asset at the date of repurchase. And then we will say that if the customer has a significant economic incentive to require the entity to repurchase the asset, then the entity accounts for accounts for the agreement as a lease does not have a significant economic incentive, then the entity accounts for the agreement as the sale of a product with the right of return. The company does not have a significant economic incentive to require Jacinta company to repurchase the asset because the repurchase price of dollar 20,000 is lower than the expected fair value of dollar 75,000. Additionally, uh, the market for second-hand equipment is very strong for second-hand equipment is very strong, and share company would be able to sell the equipment easily at the end of the 2 year agreement. Therefore, Jacinta company has transferred control of the equipment to share company of the equipment to share company on 1st January 2006. This is because share company is not limited in its ability, is not limited in its ability to direct the use of the equipment or its ability to obtain substantially all of the remaining benefits from the equipment. So Jacinta company will account for the transaction as a sale with a right of return. As a sale with right of return. Now, finally, revenue will be measured at a gross transaction price of $500,000. Revenue will be measured at the gross transaction price of $500,000 less the expected level of returns, which in this case will be nil. This means no refund liability. or return asset will be recognized. Jacinta company will update its measurement of the refund liability and return asset at each reporting date for changes in expectations about the amount of the refunds. So far, so good. And I hope you get it till here. And the drafting is clear. That's how I did. Just connecting it with the scenario and all. That's it for now. We'll see you in the next video for the next part of the question.